Okay, we are live. Welcome to Boston Basic Income. Tonight's topic is the quantity theory of money. So the quantity theory of money in simple terms says that if you double the amount of money in the economy, it doubles all the prices. So basically there's this relationship between how much money is out there circulating and the level of prices in the economy. So that relationship, as I just said, it could be, people sometimes say if you increase the amount of money, that increases prices. And then sometimes other people say if you increase prices, that increases the amount of money people need to hold or need to be spending, that kind of thing, in order to buy everything. So you can talk about the relationship going either way. But there's a lot of questions here in terms of how related is the amount of money to prices, because obviously if people have money and they're not spending it, that's not really going to affect anything. But then there's questions about how do you even define how much money is in the economy? What counts as money? So I think most of us intuitively would say that cash, dollar bills and coins and stuff like that are money, but are bank deposits money, or do they only become money when you withdraw them from the bank? And we're often making payments using debit cards, so intuitively we think of that as money too. And then you have rich people, when they have money, a lot of times what we're talking about is the value of all the stocks and bonds and everything that they own, or maybe their real estate. Are houses a form of money, for example? So what does it mean for there to be an amount of money in the economy? Because money, like how much money you spend is maybe more related to how wealthy you are rather than kind of how much cash you happen to have or how much money you happen to have in your checking account, that kind of thing. And then there's the question of borrowing, right? Like if you're able to borrow in order to spend money, should we count that spending potential as part of the money stock or the amount of money that's out there? So yeah, what does it mean for there to be a certain amount of money in the economy? What counts as money and what doesn't? And why does it matter? In what way does it affect prices? In what contexts does it affect prices? And we can ask, to what extent is it possible to change the quantity of money without changing the price level? To what extent is it possible to change the price level without changing the quantity of money? What about foreign money? If people can import American goods by spending their own domestic currency, how does that affect American prices? If China prints a bunch of yuan, does that cause inflation in America? Why or why not? Or to what extent? What about basic income? To what extent does basic income add money to the economy? How can we know what amount of basic income will cause price inflation? Is inflation even a problem in the first place? To what extent can we prevent inflation using taxes or other economic policies? All of these kinds of things. To the quantity theory of money, a lot of times that's premised on the idea that the real economy is doing its thing, and if you just add money to the economy, then the real economy will keep doing its thing and the prices will scale, or at least in the long term, now there's more money, but the economy is exactly the way it was before. That's kind of an assumption that quantity theory of money makes. So, but does it depend on the way in which the money is added? And then what effect does basic income have? Because you're adding money to a specific part of the economy, and you're not just adding money one time and having like an effect later. It's a constant stream of payments going to people. So these are kind of some questions that we can start with, and if you have some ideas about thoughts about those questions or further questions that you want to raise about quantity theory of money, inflation, basic income, what should count as money when we're counting money, or if it even makes sense to do that, yeah, we'll go around and get people's initial thoughts. You can pass if you want. We'll start with Derek, and then Bethany, and then Eddie.
Coming from the perspective of someone who got into economics kind of through basic income, who got motivated to study it from that, quantity theory of money has actually kind of become like my favorite topic because it comes up so much and it seems to be so pervasive. I like to think of it as not just the specific theory put out by Fisher or Friedman, but a kind of idea, a general ideal way of thinking about money, an emphasis on the importance of the quantity of money. And you see it show up in all sorts of ways. People thinking about, I mean, just the notion of there being supply and demand of money in a similar way to being a good. Like that's a theory of money. It's a way of looking at money. And it just seems to be behind so many different objections and assumptions that aren't even necessarily related to these formal theories. Like if you're thinking about taxation as a way of, taking money out of the system to balance the right money system, you're also kind of assuming a QTM view, even if you're not a formal subscriber of that. So everyone seems to be thinking of about the quantity of money today, and not the flows of money, and not the way that money is used to activate the economy. So it's absolutely everywhere. I hear a little bit of QTM behind almost anything that people say about macroeconomics today.
Yeah, I think that's right. It's kind of this very intuitive way of thinking about how money works. If you double the prices, well, that, or if you double the money, that doubles the prices. That's and then people kind of just have that baked in. I think that's a good point. Let's go to Bethany, Eddie, and then Ian.
Yeah, so I think that the kind of intuitive insight that is sort of related to this theory is that more money chasing the same number of goods is going to cause prices to rise, and I think probably pretty much everybody agrees on that. But when I look at the equation itself, I find it interesting that it seems like when people take the insight you talked about, which is like doubling the money creates inflation, they're kind of leaving some of the variables constant. Like, for example, you could think of it as the velocity of money is being kept constant and the number of transactions are being kept constant. So then my first question is always like, why are they assuming that those stay constant? And there's probably good reasons in like the background of economic theory for why they think those aren't going to change. But that's usually like my first starting point. And maybe it kind of relates to your point, Alex, about how there are kind of assumptions maybe that the economy is already kind of like maximizing transactions or maximizing production on its own for some reason. And so you can't really move that by adding more money. But I'm curious about that assumption. And then I guess the other thing I'm curious about is that you talk a lot about how we can't really know the amount of money, but sometimes with a theory that doesn't matter, and sometimes it does. So I guess we can speak more about like, is the insight that it's supposed to have affected by that difficulty in actually knowing how much, or is that just kind of like not really getting the point of the insight it's trying to get across? So I'm sure there'll be more questions, but those are two that I have. Yeah, thanks.
Okay, good stuff. Let's go to Eddie, and then Ian, and then Martin.
So we've been recently going through a course on money by Perry Merling. And one of the points that he makes that I think is absolutely correct, I think it's absolutely the right way to think about money, is that there's 4 different prices of money. So if you think about money, one of the interesting things that it does is it's kind of the great connector. It connects buyers and sellers of goods. It also connects domestic activity to foreign activity through the foreign exchange rates. It connects the present to the future through the interest rates. So when you lend or borrow money, you're exchanging current dollars. If you're borrowing, then you get current dollars, and you're promising future dollars. So you're actually exchanging those two things through the price of the interest rate. So the four prices of money are the interest rate, the price of goods, par, which is kind of like between banks. So the par value of bank accounts between different banks, which is kept at 1 right now, and the 4th price being
Exchange rate.
The exchange
Foreign
rate.
exchange,
Rate, right? So each one of these are 4 different prices with money, present money, at the very center of it. And so if you think about it, each one of these 4 markets will affect the price of money. So for example, if you're in a small country and people lose, and the government is involved. So if you're in a small country, the government is borrowing a great deal of amount of money. and people on the foreign exchange market will speculate, will say that. They'll make a judgment. They'll say, this company is not going to be able to pay its debt back without printing a great deal of money. And so when they print a great deal of money, the investors speculate that this price is going to go down. There's going to be a great deal of supply coming onto the market in the future. And what they do is that they bid down the price of that money, and that loses value. So that's one avenue, the foreign exchange rate. You have the price of goods. So, if like in the 70s US, or in the 70s in the whole world, really, if spending outpaces the productive capacity of the economy, and we were talking about this on Twitter with Matt, if buyers of goods are trying, they have their spending, which is when they spend the money, they're supplying money onto the market in exchange for goods. And so when the buyers of goods, which are the sellers of money, when their supply is outpacing, the production of goods, with the producers of goods being buyers of money in exchange for their goods, that's going to affect the price of money. So all four of those markets will affect the price of money. Another very interesting distinction I think that's important to keep in mind is that wealth and money are very different. So generally we're used to saying that, for instance, Warren Buffett, he has almost $100 billion. But to be very clear, Warren Buffett, he absolutely does not have $100 billion worth of money. As Alex kind of mentioned, he has, $100 billion worth of assets, particularly his ownership of stocks. But if you look at his bank accounts, I'm sure he doesn't keep more than maybe $1 million in cash, because if he kept more, that would kind of violate his principles, because he always wants to make a return on his assets. So those things are very different. And the last thing I want to bring in is, the capital consumption fee, which, I think is one very important factor that explains the deflationary forces in the economy, which the Federal Reserve has to constantly counterbalance, and which they, are ending up unable to counterbalance at this time. And the reason for that being that productivity growth, if you look at it, it has two effects. One is the increase of production relative to labor. So one effect is that we produce more. The other effect of productivity growth is that we use less labor to do it. So the demand for labor actually goes down. So at the same time that we can produce more, however, the labor that economy demands to produce it goes down. And unfortunately, as Alex likes to point out, in the absence of UBI, the labor income is also, what people use to consume for 80% of the population. And as a result, when you reduce labor demand in the economy on a relative basis, the consumers end up with no money to buy all the things that you're producing. And so that's kind of the deflationary force, which, at its extreme, gives you a deflationary crash in aggregate demand in the economy, which happened in the 30s for the Great Depression, and which is beginning to happen right now. So that's all I'll say for now. Thanks.
That's all. Yeah, so lots of interesting stuff there. Definitely, yeah. So some of us in the Boston Basic Income group and beyond are going through Perry Merling's Money and Banking class right now. So I highly encourage people to join up. We have a thread going on Reddit, and we're basically going through lecture by lecture and reading by reading and discussing it. So definitely check that out if you're interested in that. As Eddie mentioned, there's the four prices of money that Perry Merling talks about. quantity theory of money is really about one of those prices. It's about the price level. So the price, the average price of goods in the economy, goods and services. So certainly those other prices like exchange rates and interest rates and par all relate to the price level. And it's interesting to go through this class because he actually doesn't really focus on the price level that much. He focuses on the other prices. But it's all connected. And then the question is, how do you keep the price level stable? So that's more the QTM side of things. So let's go to Ian and then Martin and then Mitchell.
Yeah, so I don't know, thinking about what money is, I like what Eddie just said about the difference between money and wealth. And I guess it makes sense that a basic income would be giving people money, not necessarily increasing their wealth. I guess that wouldn't help the economy to make everyone wealthy if they're not, able to spend the money. So, I thought that was interesting. And I think about like, with the inflation piece and the quantity theory of money makes me think of like Bitcoin, how there's, planned to be, a very, a set amount, and then, no more, after reaching that amount. And I guess I want to hear more about, what is wrong with the quantity theory of money. I know, Alex, I've heard you say inflation is not necessarily a bad thing, or, I've heard you say like I think the national debt isn't, necessarily a bad thing. And, these are arguments I've heard a lot from people to argue against basic income, or, people saying, what about that? And, I know in the article I read, I think it said that the assumption of, full employment is not a good assumption to make, that's not, unrealistic to assume that will be in place, and a couple of assumptions that are unrealistic. Just interested to hear the discussion today.
Okay, great. Yeah, lots of interesting thoughts in there, especially I like that you brought up Bitcoin because it's very much predicated on this kind of quantity theory idea that you can kind of control how much money is out there, and then it'll all work out. And some other things, but I don't need to go on a Bitcoin rant right now, but maybe later. So let's go to Martin, Mitchell, and then Richard.
So I'm just going to make a couple of kind of snarky comments. I'm so old that I actually went to college and took a course in economics when economics seemed to make sense. And if I'm not like a big business person and all that, but I listen to Bloomberg radio for about 15, 20 minutes in the morning, when I make coffee, and then it's off for the day. What I would challenge people to do, whether you're interested in economics, interested in finance, and any of that kind of stuff, is turn on Bloomberg radio in the morning when they do a program called Surveillance at 7 a.m. in the morning. And don't pay any attention to anything they say, except listen for the members. There's about 3 of them say something about, like, something doesn't make sense. Like, the market moved this way and it didn't make sense. Like, something else over here happened and it's never happened that way before. This theory should have predicted Y and it's doing Z. So we're in a pretty interesting time. I probably mentioned this on a couple of other meetings, but sometimes I think to myself, shouldn't the virus have wiped out about a quarter's worth of economic activity? Not exactly a full quarter, but if it's 3-4 months of this work from home and a lot of people laid off and record unemployment claims and all that, and if the stock market is a sort of forward-looking discount mechanism, why is the stock market still at the price levels that it at? I mean, just how do you explain that? And if you can't explain that, then is there some theory that we've in the past held as being useful. Doesn't have to be perfect, but some models are useful. But it wouldn't seem to be a really good model that would explain why we could be having the kind of economic activity or lack of globally, and yet the stock market is, pretty much near record levels, pretty high, goes up and down, good bit of volatility, but not the most. And then my last snarky comment will be, this is probably attributed to Yogi Berra. If not, we'll go ahead and attribute it to him anyway. The future is really hard to predict, especially if it hasn't happened yet.
Yeah, that's Yogi Berra. At least I've heard it attributed to him before. Yeah, so those are interesting points. And I think, I don't know if you've taken a look at the Perry Maerling stuff, but he's very good at looking at crazy, unprecedented stuff that's happening right now in markets and applying his kind of framework and coming up with plausible explanations that that intuitively make sense. So it might not necessarily always be the right explanation, but it's pretty compelling. Let's go to Mitchell, and then Richard, and then Dan.
On that Bloomberg, you actually can download them as a podcast as well, just to let you know. And then on my point is on money supply, there's different factors. I mean, we can use a basic income to affect the money supply, but also loaning affects it as well. And I'd like to explore that, and because I know there's a couple formulas in this article. So that's all I have to say.
Okay, thanks. Let's go to Richard, and then Dan, and then Steve.
About what Bethany said, that having like a basic income would not affect transactions. If people who didn't have money before suddenly had money, of course the amount of transactions would be different. But the wealthy, they wouldn't. The amount that they spend or what probably wouldn't differ all that much. And then you see in like television periodically that they have the reserve the dollars, the reserve currency, and then they have these pallets being shipped off to say Russia or something. But there's a different amount of cash not being in existence, but not in circulation. So if money is out there but it's not being used for anything, it won't matter. The inflation or whatever won't occur.
Yeah, I think that's a really good point. Like even if the United States government just like printed $1 trillion of $100 bills and didn't spend it, that's as if they did nothing in a way. And then there's lots of places in the economy where you can ask, is the fact that money is here, does that in this particular place, does that make a difference to the price level, to consumer behavior, that kind of thing? So let's go to Dan, and then Steve, and then Joan.
Yeah, so a couple thoughts. So this equation was developed in the 1930s, and so the U.S. was still on the gold standard, and so I think that would kind of make sense, intuitive sense at that time, when you have the dollar fixed to a commodity which has a certain amount, available, that changes in the quantity of money will change prices more in a more connected relationship. So I think once we got off the gold standard, that relationship starts to break down. Another thing is that the dollar is as Richard just said, the dollar is the global reserve currency, and it's also the primary denomination of oil. So like anybody who buys oil from Saudi Arabia, for instance, has to pay with US dollars. So and thinking about the quantity of money, if you're thinking about, dollars, it's not just the amount of dollars that are in sort of the US, it's also the dollars that are, in the world as a whole, circulating through different economies. And then I think UBI affects the quantity theory of money in sort of the way, like the ratio of sort of the money printing to establish it versus the taxation that you may or may not want to do to remove money to sort of offset the quote unquote cost of UBI. So, the amount of basic income that would be spent into the economy increases the quantity of money by that amount. And then if you wanted to then impose a specific tax to remove money, that would decrease the quantity of money by that amount. And so there would be some sort of, net amount that's added. Obviously, that's not a requirement, but I think that's sort of UBI's relationship, is that it's certainly always going to increase the quantity of money, no matter how we might think about that. But and then so I just think that it's there's some thoughts about that.
Cool, yeah. And then we can ask the question: if you're removing money from one part of the economy, does that make room to add money to another part of the economy? That kind of thing too. Lots of interesting thoughts. Let's go to Steve, Joan, and then Matt.
A number of UBI critics say that if you double the amount of money, then you'll do nothing but double the prices. But I think that ignores the fact that businesses, the supply sector, might actually respond to all this new money by increasing production. And I think in the article, Friedman says something about maybe when M goes up, velocity also increases, and that makes perfect sense. But then you have to assume that the supply side will respond, and prices don't have to go up, just numbers of transactions can go up. That's it.
Okay, let's go Joan and then Matt.
Thanks, I'm going to pass.
Okay, go ahead, Matt.
Sure. So the first thing that comes to mind is there's a quote from Keynes that I've run into a couple of times recently, where he says something along the lines of, we can draw a line between money and debt wherever is most convenient for us. And so, it just is an example that money is very difficult to define. And, you've got the Fed tracking, M0, M1, M2, M6, whatever, a million different definitions of different assets that mean and do different things. So it's hard to define money in that way. It's also unclear how you necessarily define velocity of money as well. It's not like every dollar, however you even define that, is circulating the exact same number of times. It's just something that's there to kind of finish the equation, I suppose. And then you get into an issue with the price level as well. Are you assuming that whatever the price level is today is the absolute natural amount, price for every good, and this is the perfect way that it should be? Because if you look at inflation from the last couple of decades, some sectors have inflated rapidly while others, the prices are constant or decreasing, housing, education, healthcare, the prices keep going up, whereas a lot of consumer goods like smartphones, TVs, that kind of stuff, the prices are staying relatively stable. And so when you're looking at inflation over an economy, what goods are you looking at? And so there's kind of a judgment call there. And I think it's hard to say oh, this is the amount of inflation in the economy, especially when you're averaging two goods that are one's going up in price and one's going down. Do you average those together and say, oh, there's no inflation? So I think there's a lot more details to pretty much all of these variables that you have to take into account before you try to apply this sort of theory to the real economy.
Yeah, I think there are a lot of details, but I think it's also true that there are some really kind of simple and important general things that matter. So when you're thinking about what prices mean and what a dollar is worth, You have to have an intuitive sense of what a dollar can buy. How much stuff can the dollar claim from the economy? And that's what makes it an effective pricing standard, to have this standard of value that's in some sense immune to market forces. So it's getting its stability from outside the market. And then the market prices within the market can move all around. Some can move up, others can move down. But then, in some sense, there's an average level of consumer prices that has to stay stable, and that's what makes the pricing work. So in order for the prices to adjust efficiently, it has to be true that there's this one thing whose price doesn't adjust, and that's money. So that's kind of the pricing standard in terms of which we set everything else. So regardless of any other details that we get into, money kind of needs to function efficiently as a pricing standard in the market. And I think that's important for the concept of inflation, because we can talk about different assets and different goods and services, the prices changing in different ways, but it's also true that there are certain things that are important to consumers, that we buy food, we buy clothing and various other things and services as well, that's kind of like the normal part of everyday life. So this is kind of a little bit of an art to decide which prices we should be looking at and putting into the market basket of goods to determine what the general price level even means. What goods do we care about? But the general sense is that it's the stuff that matters the most to ordinary consumers, to ordinary people. Yeah, Bethany, go ahead.
This is basically what you've just said, but your brother mentioned that you've said that inflation isn't a bad thing, but I just wanted to make sure you corrected that, which is that you actually do think of stable prices as being very important. Sorry, Ian, not to call you out, but I just want to make sure that was clear.
Yeah, stable prices are very important for money. So I wouldn't say that a small amount of inflation or even deflation is the end of the world. But generally, you want a stable standard pricing unit in order for the market to be able to set prices efficiently. Over the long run, it doesn't really matter. It doesn't matter that a dollar could buy 50 times as much stuff 100 years ago or something like that. That doesn't matter. What matters is that you have this day-to-day pricing standard that's relatively stable. And then there are arguments to be made for kind of like low and steady inflation over a period of time. There's various reasons why economists and policymakers want that. But it's not necessarily something you would need in the context of a world with basic income. Let's go to Eddie.
So I really like what Martin said about turning on the radio and they're talking about markets and they're always saying this makes no sense. That's absolutely right, and I think he's absolutely right that tells you that indicates to you, and economists say the same thing. The economists are also kind of confused about our current situation, and it tells you when you're confused, when something doesn't make sense, that there's something that you don't understand about the situation. Your understanding, your theory is not complete. Something's wrong, something's missing, something's off about it. And he mentioned the stock market, and I think the stock market is one very interesting part. And so I would actually say that the stock market currently is at a kind of a crossroads. It's almost like if you balanced a pencil upright on the table, and there's two different directions that it can fall over in. And so one of the possible directions that it might fall over in the near future is that the prices just might start crashing again. You saw them kind of crashing in March, and then they kind of took a V and came almost all the way back up. But they could crash again. That's one direction. And then the other direction that they could go off in is that they could continue to go up. But if they continue to go up, and you have to ask, what does that mean? And I would argue that what that pathway would mean would be that the economy is going down, but stocks are going up. And what you're actually seeing is actually the beginning of the loss of value of the dollar. It would actually be the dollar going down, and you'd see other assets going up, such as gold and real estate. You would see almost all types of assets starting to go up. And you might also see it in the foreign exchange rate.
And in consumer prices.
And you'd begin to see it in consumer prices, which are connected, because as the dollar goes down on the foreign exchange rate, and we import such a huge amount of our goods, then those import prices will go up as the foreign exchange value of the dollar goes down. And so how do I explain that? What's my intuition that makes me think that is happening? On the one hand, you have the aggregate demand crash and the deflated consumer, which are unable to consume. So what's going on here, in my opinion, and to bring it back to the four prices of money, one of those prices is the prices of goods, and the prices of goods is affected by the production and the consumption of goods. And so, with capital consumption theory, we're currently in a stage where the consumption is not enough, and the capital is too much. So if you think about those two things being unbalanced, that will actually affect the interest rate of money. It affects the interest rate of money because it affects ultimately the return on real assets. So remember, the interest rate is kind of connecting present money and future money, but on the other side of it, you also have real assets where if you buy a light bulb factory today, you're going to spend $10 million, but every year it's going to give you $1 million worth of of light bulbs. It's going to make 10%, and so that is going to anchor the interest rate market, because clearly if in 50 years you can get $50 million worth of light bulbs, and you only have to spend $10 million to build a factory today, then clearly the future money is worth less than the present money through the interest rate. And so what happens is that when you have a lot of excess capital and not enough consumption like today, the returns on real assets go down, and interest rates go down with it. So that kind of explains where we are. When we were in the 70s, it was the opposite thing. You had a lot of consumption, not quite enough capital to sustain the consumption, not quite enough capital, working on creating production to sustain that consumption. And as a result, you see very high interest rates, even kind of floating up, even actually independently of what the Federal Reserve does, because that's a sign in the market that you have not enough capital, and so the price of capital goes up.
So there's a lot of interesting points here, and something to keep in mind too is that a lot of prices that we see out there are not necessarily prices that are just determined by an efficient market. So for example, if we see the stock market going up, we can say, why is that happening? And we can try to predict what happens next with it, or we can try to make some kind of predictions. But if what's happening in the stock market is due to our economic policy decisions, is due to kind of like the Fed propping up things in a way that also happens to prop up the stock market or something like that, then it's not really a market price anymore, or they are market prices, but they're being distorted away from what they would be if the Fed hadn't done that. Like maybe right now the stock market is crashed if the Fed hadn't intervened, and then predicting what happens next is partly predicting, well, what's the Fed going to do next? What are the politics going to be, right? What decisions are we going to make in economic policy? So it's not as simple as like looking at the economy and kind of like having a sense for how the economy works, because there's these kind of exogenous forces coming in from political risk or policy risk.
Right. So it's still a market price. The stock market is still a market price. The Fed isn't buying the stock market directly, but it's a distorted market price. They're taking the interest rates down, so they're distorting the interest rate of money, and that's sending the prices up. At the same time, to bring it back to the four prices, that the economy is deflated. The consumer does not have enough money. And so because of that is dragging down on production, which drags downwards on the price of the stock market, because if the companies are not able to grow in a growing economy, then theoretically then they're worth less due to a kind of a declining future in production. So those are two forces that are dragging at the stock market right now, and it will be very interesting to see which one wins. That battle.
Yeah, I think so. There's kind of this distinction between endogenous forces and exogenous forces. So endogenous is what happens inside of the economy as a result of other things going on in the economy, and then exogenous is kind of what comes from the outside. So in order to be able to make decisions about how your policy wants to intervene with the markets and with the economy and stuff like that, you have to have some kind of theory or model for how these endogenous forces are going to work. So we can have a general sense that if people are spending less, that's less profit for businesses. They're not going to produce as much, and you would expect stock prices to go down. So that's kind of like the endogenous effect you're talking about, or one of the endogenous effects that you're talking about. But we didn't see that happen because there was kind of this exogenous intervention by economic policy. Right? Yeah. Yeah. Let's go to Dan.
Yes, I think to echo what Alex just said, the reason the stock market is still up, even though the economy is in shambles, is because of the Fed's actions. They, stepped into the market. It's not just lowering interest rates. They started buying, ETFs of corporate bonds. They just announced they're going to start buying individual corporate bonds. So, all of these actions, I think, signal to investors that no matter what happens in the economy, the value of these assets can be artificially inflated by the Fed, at will. And so I think that sorry, lost my train of thought there. And another point too is I don't think the dollar is going to weaken with what's going on right now, simply because the virus is affecting the entire world. I think it would be a much different scenario if the virus is only affecting the U.S., or only affecting the Eurozone. That would affect the euro, or if it was only affecting Japan, that would affect the yen. But because this is a global pandemic, people are going to safety, and the safest currency that exists is the U.S. dollar. And so I don't see the dollar weakening because of the crisis, the coronavirus crisis, because of how it affects the entire world. Those are some thoughts.
Yeah, I think that's exactly right. The dollar is the world reserve currency and the world's, payment currency. So, if people are being squeezed right now, they're looking for dollars. So I don't imagine that you'd see this kind of weakening of the dollar endogenously. So we'd have to have some kind of policy that, pushed more dollars out into the world in order to cause the dollar to weaken. It's not going to happen on its own. So I think what I want to do is go to the article and actually look at this equation we've been talking about, just to kind of like get everyone on the same page. So this is going to be the Irving Fisher equation of exchange that he uses to support his quantity theory of money. So let's share that. Okay. Okay. Fisher's equation of the quantity theory of money consists of four variables: the velocity of money, V, the money supply, M, the price level, P, and the number of transactions, T. This formula is also referred to as the equation of exchange. It relates the inflation rate to the money supply in a very simple way. So the idea with M is that there's a certain amount of money that's in the economy. And then V is just, on average, how often is that money turning over? How often is the money being spent? So you've got, say, $100 being spent twice a year. Now you've got $200 in total spending. And then on the right side of the equation, you've got the price level. P is the price level, and then T is the number of transactions, or we can even think of that as the quantity of the economy's output. So instead of paying a price for a good or service, this is the average level of prices for all goods and services in the economy. So if you've got $200 of spending, then you've got $200 of total payment. So if you've got, to keep it simple, if you've got 50 transactions, then each transaction has a price of $4. So your price level is $4. The average price for a transaction is $4. So that's kind of what those variables mean. So I said money stock for M. A lot of times people say money supply, because what you're imagining here is that there's a certain amount of money that's available to the economy. It's a supply of money that's available to the economy, and then it's that money's out there, and then the question is, what are you doing with it? You're spending it, and you're spending it at a certain rate. So in order for the quantity theory of money to be strictly true, one, we need to be able to define how much money is out there. And it also needs to be true that the velocity of money, the amount of turnover, it stays the same over time. That doesn't change. And it has to be true that the number of transactions, so the output of the economy, doesn't change. So if you're holding those two things constant, then if you increase M, then you literally have more money chasing the same number of goods. Like, that's what the equation says. You can't argue with that logic. But it's problematic because, as Matt and some other people were pointing out, how do you define how much money there is? Even conceptually, not just in terms of how you measure it, but even conceptually, what does it mean for there to be money? Like, Warren Buffett has a lot of stuff that's not money. He has his stocks and his bonds, he has his wealth, and we don't want to confuse wealth with money, but he's not spending based on how much money is in his checking account. He's spending based on how much total wealth he has. So that's what should matter for kind of the quantity theory is what's the total wealth that people have, because that's what affects their spending. They only transform that into spendable cash or spendable money when they actually need to buy something. But their overall spending decisions are not going to be made by how much money is in their bank account. So that's kind of a little wrinkle there. And then, so how do you define the amount of money? And then what does velocity mean, right? Like, if you're defining money as like some fixed number of coins that are in your economy circulating around, but the things that people are actually spending is like, okay, well, this is an IOU for 5 coins. Right, and I'm giving this to you, and you're accepting that as payment. Does that count as, is that IOU, that piece of paper, is that more money supply, or is that an increase in the velocity of the coins that it's an IOU for? Because you can, if you're limiting to those coins and there's increased spending, then all of the spending that's facilitated by kind of credit on top of those coins can be kind of rolled into the velocity. So you have the same amount of money, but it's spinning around faster and faster. And obviously that's a problem for quantity theory if you're keeping the quantity fixed and the velocity changes, because the whole assumption is that the velocity kind of doesn't change. So that's problematic. And then what does it mean when you talk about the number of transactions? I was being kind of hand wavy there. I talked about the quantity of production. Intuitively, we can understand that if consumers are spending money buying consumer goods and services, then there's a certain flow of spending, and then a flow of goods and services kind of going the opposite direction. You've got these two flows lined up with each other, and if they continue to match each other, then the price level stays the same. But Irving Fisher is, I think, often talking about just all the transactions in the economy. So if I give you $100 for this remote control, and then you give me $100 for the remote control back, and we do that 500 bajillion times, that's increased the number of transactions in the economy, but it's also increased the velocity, right? So so the equation can be true, can be unobjectionably true, and still not necessarily line up to something that's useful in the real world economy. So I assume that you guys have been staring at that MV equals PT for a little while now, and you have that baked into your brains. And we'll get to we'll go to Dan for Dan's comment.
Yeah, so two things. I would define the money supply as sort of same day access is kind of the standard I would think about. Like, so the total amount of cash, total amount of bank deposits and checking accounts, and the total amount of credit lines that exist. So basically anything that you can access today, not like when you deposit a check at the bank account, you don't have access to that money until generally the next business day. So I guess we can like to hear feedback on that, I guess. And
Yeah.
then, yeah.
Yeah, so I think one issue with that is that if you're Warren Buffett, you're planning ahead for what your access is going to be in the future. And you can plan whatever same day access you want. And ultimately, your spending is still going to be determined by your overall wealth. It's not going to be determined by what you happen to have access right now, because what you happen to have access right now is going to be determined by your overall wealth. Does that make sense?
Gotcha. Yeah, yeah. And then my second point was, we're talking about more money chasing the same amount of goods, and that sort of leading to inflation. Something that I've been thinking about is when we think about government deficits, because the government is spending money into the economy and then taxing money out, and those two things don't line up. Just kind of like some of the basis of MMT. And so the deficit is just the amount of money that's added minus the amount of money that's subtracted.
Right.
And so to me, it would seem like an intuitive sort of, I guess, limit or just threshold where we might start to see noticeable inflation is at the level of total GDP. So like if the government, so the size of the economy, if it's like 22 trillion, then to me, that's the sort of limit on the government deficit before you start to see inflation. Does that make sense, or how do we think about that?
Yeah, I think to some extent that makes sense. The limit before you start to see inflation is not necessarily what the GDP is now, but it's going to be determined by potential GDP. Because like we were talking about before, if you're enabling more spending or facilitating more spending in the economy, that can also facilitate more production. So that can actually help boost GDP. But the question is, what's the limit of GDP? And in terms of the money flow, or does that make sense? That part?
Yeah. But I guess my question is, what do you think about in terms of deficits relative to inflation? Like, because when we're talking about, because I think we all agree that more money chasing the same amount of goods is what might
Yeah.
start inflation or cause inflation. And so theoretically, it would seem like the government can spend a certain amount of money before, relative to its taxation policy, before we start to see inflation, because you have more money chasing the same amount of goods. To me, that seems like the point where the deficit is bigger than, and not the national debt, but just the deficit, the annual spending being higher than the size of the economy, like what you can buy in the economy, everything, totaled together.
Yeah, so MMT is modern monetary theory. They do kind of emphasize, how much money is being added to the economy and how much money is being taken away. But it's also important to pay attention to how the money is flowing through the economy. So within the private sector, money can go to a lot of different places. If you hand a lot of money to Bill Gates, that doesn't really affect the productive economy because he wasn't going to buy extra consumer goods with the money you gave him. If you give money to ordinary people, that's going to go towards real productive capacity. But then it's not going to stay with the consumers. You need a mechanism to get money into the hands of consumers. So if you just keep giving money, if you just give money to consumers and there's no automatic mechanism by which it gets back to them in the economy, then you need a constant inflow of money, because the money is even if you don't tax it away, it's going to be accumulating in the economy, in the pockets of Warren Buffett, Bill Gates, Jeff Bezos, and and that gets complicated too, because they're not accumulating cash. They're accumulating other assets. So they're transforming their cash into something else. So then you can ask, well, are they transforming their cash into a private sector investment asset? Are they investing in some business somewhere? that's actually going to be productive and producing real stuff? Are they just investing it in financial sector bets that have no way of getting either production or money back to consumers again? Or are they investing it perhaps in government debt? Are they buying up treasury securities, in which case they're transforming cash, which is not an interest-bearing asset, into something that you'd actually want to save? Like, cash is the thing you spend, not the thing you save. So there's kind of like all these different aspects of where the money comes from and where it has to and where it ends up going, and we can kind of influence those things. But what matters for inflation is how much money is flowing through the consumer economy and how many goods and services are flowing in the opposite direction, and whether those things are lined up. So I don't think you can say that, oh, we're just adding money to the economy and then kind of assume that over time it'll spread itself out and the economy will just kind of be back where it was, but with more money in it or something like that. Because the money doesn't necessarily flow in a circuit. It's, like if someone doesn't have a job, they're not necessarily going to have a source of income. Maybe unless we intervene in some way, other than through the labor market, or even by creating a job that's not even necessary for the output of the economy, stuff like that. I know that was kind of a long rant, but it's not just about the quantity and getting the quantities right in the economy. There's more to inflation than that, I guess, is my point.
Okay, cool. Thank you.
Okay, let's go to Derek.
Yeah, so you sort of critique this equation by way of looking at the variables and then talking about the difficulty in defining, much less quantifying, those variables. So that's one way to go at it. But another way to look at it is kind of to think about, well, what is this trying to describe, right? And the article 2 mentions that what's kind of funny about this theory is that it's a description without a really powerful, it doesn't provide a suggested causal theory to explain what we're looking at. So like this equation is something that can be true. It's possible, but the question we're interested in is like, is this true of the system that we happen to live in? It's kind of like the difference between math and physics. A lot of things can be true mathematically, but then for it to be really good physics, you typically want a theory about the phenomenon, the observable phenomenon that this describes. And I think intuitively, I mean, we talk about inflation a lot as this kind of like law of economics, this thing, but we know that aggregate inflation means that all prices going up. Well, so who are the relevant actors? The actors would be price setters. So in order for quantity theory of money to really sort of be compelling theoretically, we have to know, well, how is a price setter, what do they care about the quantity of money? And we know that business is kind of, we can't really imagine, I can't imagine why an individual business would care about the total quantity of money that other businesses have, much less that the entire economy has. The total quantity is just this amorphous number that theoretically exists, but will increase, decrease. They care about attracting flows of money to them, right? So that's where I start looking at this. That's how I try to critique this, not necessarily trying to disprove the equation, but trying to ask, like, well, what is this trying to model? What is this equation a model of?
Yeah, that's good. Yeah, I think businesses can't know, things like how much money is out there. They're not paying attention to that. But they, as you said, they are paying attention to the flows. How much money is coming into them? Can they raise their prices? Is that going to increase their profit? That kind of thing. So then the question is, does some idea of some theoretical concept of the quantity of money, does that affect the flows that are coming into businesses? And the quantity theory of money proponents would say that it does. I think you could say that, but then it's also if you just say okay, the level of spending in the economy has increased and we're assuming velocity is stable, therefore the amount of money has increased, but then you're not learning anything from the amount of money. You're just kind of deriving the amount of money from how much spending there is, that kind of thing. So like you said, the equation can be read in any number of different directions, and the fact that it's true doesn't necessarily tell us about what's causing what, or give us any insight into, hey, is there something we can measure that is going to tell us what's going to happen with inflation, that kind of thing. Let's go to Steve.
Thank you. I think that the velocity of money is a useful concept. I think that recent quantitative easing, which I'll describe as adding money to the, increasing the money supply, but from the top down, so basically giving it to rich people and hope that it trickles down, this has not worked. It has not kept inflation going, and it basically hasn't trickled down to people who need the money. So we'll describe that as a high supply but low velocity tactic, and it didn't work. On the other hand, there's this thing in the stock market, high frequency trading, where the velocity of money is fantastically high. And I think they do, it's like $5 quadrillion worth of business a year in high frequency, low percentage trading. So that's fantastically high velocity, and that doesn't do anybody any good either. So I'm sort of losing interest in velocity as a diagnostic of anything. In the middle there somewhere is universal basic income, where the money goes to the bottom, where it will be spent, and that's sort of medium velocity. And but because it's spent into the productive economy, it actually does consumers and businesses some actual good. So that's how I'm looking at the equation now.
Okay. Yeah. I mean, I think you're right that velocity is not necessarily a useful diagnostic of anything, and that's especially true because a lot of times, even with quantity theory, people measure the money supply and they measure the transactions and they measure the price level. And then the velocity is just this residual that whatever the other three things are, the velocity is what it is, that kind of thing. They don't look at the velocity directly. That's kind of like a hard thing to calculate. And the money supply is also a hard thing, but they do come up with proxies for that, M0, M1, that kind of thing. So let's go to Matt.
Sure. So yeah, I wanted to talk briefly about what Dan was talking about before. I do remember on Twitter some MMT economists saying that like the theoretical limit on government spending is the size of GDP, which is a pretty crazy thing to hear before you fully understand what it is that they're talking about. And yeah, I mean, I think what really matters is where the money is going in the economy, because different people have a different propensity to consume, which generally decreases as their income gets higher, which I think Dan also brought up a bit in his paper that he put in the Facebook group the other day. There's also related to MMT and GDP, Matt Bruenig, who's like a leftist policy writer, I suppose. He writes about how MMTers claim that a UBI is inflationary, but a job guarantee is not, because wages get counted towards GDP, but transfer payments do not. So if a job guarantee worker rakes some leaves, that gets counted towards GDP, whereas if you get your UBI and then you go rake some leaves, that doesn't get counted towards GDP. And so they say, oh, that is inflationary. So he comes up with some like sarcastic proposals like, I'll make everyone send out a tweet before they get their basic income, and then it's work and that counts for GDP or whatever. I think I wanted to talk briefly about quantitative easing. As I understand it, it's less of throwing money to rich people, but more of an asset swap. Generally, this is swapping reserves, which is money that banks hold at the Federal Reserve, for bonds, which is essentially interest-bearing dollars. And so banks only spend reserves with the federal government and with each other. And so it's not usually counted towards the money supply as we think of it, because you can't use reserves to buy real goods. What the Fed does when they're trying to do quantitative easing is that they're worried that banks don't have enough reserves to meet their requirements, or they need more reserves to lower the interest rate on reserves. which makes banks more likely to lend, which hopefully will get more money in the economy and get consumers more likely to spend. But it's not as straightforward as, they're giving rich people a bunch of money. The Fed is technically not allowed to increase the net worth of the non-government sector. They're allowed to do asset swaps. It gets a little murky in cases like now, where they're buying lots of assets that are, junk debt or have questionable value, and so they might be increasing the net worth. But generally, they just do asset swaps and hope that someone else creates money and that gets to consumers.
Definitely QE is an asset swap. It's not a flooding of money. You're swapping one asset for another. So they're holding the bond, you're replacing that with reserves. I don't know that the motivation for QE is to flood the banks with reserves. I might instead argue that flooding the banks with reserves is a side effect of QE, and that the main reason for QE is to put a backstop on the prices in some of these in the markets for some of these assets. So the Fed is promising to buy up certain assets to prevent their prices from going to zero, and as a side effect of that, you end up kind of flooding the banks with reserves. But it's not necessarily about increasing the money supply, as it were, and it's not necessarily about like if it were just about the reserves, they would have stopped, with banks having sufficient reserves, but they stopped once banks had way more reserves than they were ever going to lend out. And that's kind of been the situation since 2008, since the 2008 crisis. Does that make sense?
Yeah, I guess my one question would be like, do like the purchases of like corporate bonds and stuff, is that technically within the domain of quantitative easing? Because I understood it is just bonds or just government bonds, but is it more used more broadly than that?
I think it's more in that direction. I think people would use the term quantitative easing to describe it. And again, you're backstopping the markets. Back in 2008, a lot of this government debt was being used as collateral in other borrowing. So then when the price of government debt went down, it was hard for anyone to borrow because the collateral wasn't worth enough anymore. So they were kind of backstopping the market for government debt. But I think now they're backstopping the market for corporate debt. And again, it's not about adding reserves to the banking system because the banks have plenty of reserves. It's just a side effect. Yeah. Let's go to Bethany.
Hey, so you might have said this already, but in terms of the equation, I've heard you talk a lot about thinking of the flow, because it's easier to think of like the combined money, stock, and velocity than it is to try to like parse those apart. So that way of talking about it has been helpful to me. Thinking of that MV as kind of like the flow of money towards goods. So that was one thing. Another thing is that often when we've talked about this, you brought up the fact that if you were to kind of give money or double the amount of money that every person had, then that would double the prices. And you always explain that to me, and I get it, and then I kind of like forget how that works. But I thought that was an interesting way in which like some of that, not exactly the inside of the equation, but like kind of relates to that, and that you would say is true. So I'm curious if you could remind me why that makes sense. Maybe everyone here knows that clearly, but yeah.
So yeah, it's not just doubling the amount of money that every person has, but doubling the amount of money, doubling the amount of spending. When you do that, essentially what you're doing is just redenominating the money that everyone has to be double. And it doesn't change the economy at all. So this is kind of the intuition behind quantity theory of money, that if you do this, that over the long run, the end result will be the economy will be the same. There's just more money out there. So that in the long, there might be some distortions as you're introducing money to a certain part of the economy, but then it kind of spreads itself out, and the end result is that you have the same thing, but everybody's has more money and is spending more money proportionally.
But I guess I'm wondering, I always forget why doing it that way wouldn't still potentially increase like production of certain goods and things like that.
Because you're doubling everyone's spending, you're doubling all the prices, you're doubling all the money that everyone has. You're in the exact same scenario you were before.
No, but I mean, I know you say that, but it's not always obvious to me, because like you're still giving people with very little money like twice as much money now. So why don't they then want to buy more food, and why isn't there more food production? than there was
They
before.
they might want to buy more food, but you're also doubling the amount of money of all the rich people, of all the firms, and you're doubling all their spending. So the profitable prices, whatever the equilibrium price is, that's also going to double.
Yeah, I guess yeah, that seems important though, and that's like not so obvious, like
Yeah.
without thinking about it more.
So I guess the question you could ask, kind of the thought experiment here, is imagine that you just declared that every dollar was, 2 Quaibarks, and our new currency is the Quaibark, right?
Yeah, but I know you're saying that, but I'm saying
Yeah.
like it's not obvious why, without thinking about like what's the most profitable thing for a company to like producing more or raising the price. It's
Right.
not obvious why it's like the Quaibark thing, because you might think like, oh, well, people still have more money. Poorer people who are spending still have more money, and like why wouldn't they be able to buy more food? So I think you need that
Are you saying that you
intermediary
don't
step.
understand it, or that it might not be obvious to other people?
A little bit of both. Like I keep having
Okay.
to reconstruct it in my mind, and I only like vaguely understand it, and it's not something that I think we've talked about explicitly in the conversation, which is like what's more profitable for the firm, increasing the number of things that it's producing or increasing its prices, because that's kind of important to this idea of
Right.
whether you get more production or inflation, right?
So yeah, I mean that's going to depend on the on kind of the elasticity of demand, right? So if more people have money to spend, then it can be profitable to produce more at current prices or even lower prices, right? Because lowering your price a little bit gets a lot more customers, that kind of thing. So that means demand is very elastic. If demand is very inelastic, then it can be profitable to produce fewer goods at higher prices, because you don't lose that many customers. This is when people just have enough money and they'll pay whatever price. You don't lose that many customers, but you'll still but you'll be able to sell your products for a lot more money. So then the most profitable price, if this is assuming no competition or anything like that, the most profitable price to sell your product is the price at which you're not going to profit more by raising prices, and you're not going to profit more by lowering prices. So when you're imagining doubling the amount of money, you've got the prices and the quantities on your kind of supply and demand graph or whatever.
Or we should say doubling the spending, I guess, right? To be more precise.
Doubling the spending, yeah. I mean the prices correspond to the spending, right?
Mm-hmm.
So you've got your let's see if I can do this in a way that you've got your price axis and your quantity axis. Essentially, what you're doing is you're stretching the price axis, and the quantity axis is staying the same, right? So the quantities of everything stay the same, prices of everything double, and then if you want, you can redenominate it, and then it's scaled back down again.
Yeah. So I guess it seems like an important thing to think about in terms of whether the quantity theory of money prediction comes true is whether you're changing the distribution of spending, like
Yes.
like versus not, which is I guess kind of what I was trying to get at with my comment.
That's right. And basic income does change the distribution of spending, and because it's an ongoing thing, it's a permanent change to the distribution of spending. And one could argue that there has to be money flows going into the economy at all times. So the idea that the economy just does what it does, and you add money as a one-time thing, and then it's back to where it was, is not like, there's no such thing as a steady state, stable equilibrium economy that just has a certain amount of money that keeps going around and around and around, right? There has to be a mechanism to get money back into the hands of consumers. And the natural economy, people accumulate wealth, they accumulate money, and there isn't a mechanism on its own to get money back to consumers. So we have to use economic policy to create those mechanisms.
Yeah. So that's interesting, because even though basic income, it's the same amount of money to everyone, it vastly changes the distribution, because a lot of people who don't have money now get money, or a lot of people with a high propensity to spend get a lot more money than they had before, stuff like that.
Right. And if you're just thinking in quantity theory terms, you're like, well, not only are you adding more money to the economy, but you're adding more money to the economy forever with the basic income. But what you're really doing is you're changing the flows. You're changing the source of consumer income, or you're changing the distribution of those flows, and maybe even the size of those flows. But then you have to ask the question, where is the money coming from, and then where is it going to, right? It's not the economy is not like a balloon where you're adding more air to it, and the money is air, and it's just in there, right? That's not the right way to think about the economy. Okay, so we have a couple more hands up. I want to get to the second equation here because it's a different, it's also a quantity theory of money equation, but it's a different quantity theory of money equation that means something different almost.
Can I,
so yeah,
sorry,
go ahead.
I also wanted to say that we watched something by Perry Merling on a lot of the questions about quantitative easing and other things that a lot of people seem to have knowledge about in this group. So I'm just going to post that link in the chat, like the actions that the Fed has been taking and so on. He talks about it and kind of breaks it down. So you guys might be interested in that. So I'll put it in the chat.
Cool. So this is the Cambridge version of the quantity theory of money. So this is kind of the perspective that Keynes was coming at it from, and it actually, like, the article says that Irving Fisher invented the quantity theory of money, but this idea is very intuitive. You know, more money means prices will go up. You know, that kind of thing. It goes way back. So Irving Fisher is the most famous guy, but there was this other tradition at Cambridge University that Keynes started with that eventually developed into kind of his liquidity preference theory and stuff like that, which you may have heard of, or maybe not, but that's okay. So Cambridge version of the quantity theory of money. A slightly different approach to formulating the theory is the Cambridge version of the QTM. They keep saying QMT in here, and they get it wrong every time. Proposed by John Maynard Keynes. The difference between Fisher and the Cambridge quantity theory of money is that the latter assumes that a certain fraction of the money, K, is held for convenience and security. Thus, the Cambridge equation is for QTM, this article is terrible, but the equation is right. M equals K times P times Y. So this is MD because you're talking about money demand here. So MD is money demand, P is the price level, and Y is economic output. So the idea here is that if the economy is producing a certain amount of stuff, and I talked about this a little bit in the introduction, that everybody's going to hold a certain amount of cash because they need to make those daily transactions. So this is kind of what Dan was getting at earlier, that, you know, what matters is the daily transactions. But consumers make a choice about how much cash to hold. So here you're just looking at the cash and you're saying, well, how much cash do people need to hold given the conditions in the economy? So this is the demand for money rather than the supply for money. So the first one was about money supply. It was talking about the money stock, right, in terms of supply. This is still talking about the money stock but in terms of demand this time. So you can, so I think if you have money flowing through the economy and you have a certain level of consumer spending, then this is going to be true, that there is a certain amount of money that people need to hold for daily transactions. And maybe in the past that was mostly cash. Now we actually spend bank deposits directly, so we probably want to include that, even in, you know, when John Maynard Keynes was writing his tract on monetary reform in the early 1920s, he actually had a version of this equation that did include bank reserves as well. So there was an amount of cash that people were holding, and then there was amount of bank reserves that was factored into the equation as well. So I think you know, that's right. You can see that people will hold a certain amount of money, and maybe that might not be something that's constant, depending on people's feelings, that kind of thing. They might want to hold more, they might want to hold less. But if you assume that people generally need to hold a certain amount of money in order to do a certain amount of spending, and you see how much spending there is, then you can figure out the money demand from that. So this is a quantity theory of money. It's still talking about a stock of money, not a flow of money. So there's no velocity in here at all. That's something that's important to pay attention to. It's not thinking about what people are doing with spending of the money. It's just thinking about how much money people need to hold in order to make the economy go. But I would say that this equation, as with the other one, is also true. It's just not telling us necessarily the whole story. So let's get out of the share here. We've got a few people with their hands up. Let's go to Eddie. You've had your hand up a while.
Yes, so I really like what Derek and Bethany are talking about, because I think it's and also Alex, because I think it's very relevant. When you look at the equation, quantity of money times velocity of money is equal to what is it? I think it's GDP. What is it? How's it formulated?
It's equal to total spending. So it's equal to the price
Total
level
spending,
times
total
the real
spending.
GDP. Yeah.
Oh, price level times the real GDP.
Yeah.
You're taking something which is very interesting, which is the nominal amount of spending, what Alex would call the money flow, and you're actually theoretical entities they can't measure, and it's unclear what they actually tell us. So if you think about it, the velocity of money is just the nominal spending divided by the total quantity of money.
Yes.
So on the left side of the equation, what you really have is that the quantity of money times a theoretical construct, again, which is floating up there, times the nominal amount of spending divided by the quantity of money, again, is the nominal amount of spending, which is also the price level times the real amount of spending. So you're kind of going around in circles. You're kind of going straight up into theory, straight back down without actually illuminating anything. And I think it's much more. I think there's a couple of things. One thing that is that Alex talks about, which I think is correct, is that what's more interesting is the stocks versus the sorry. What I want to say is that one of the things that's interesting is that is the stocks versus the flows and our understanding of supply. So the part, as Derek talks about, so Derek goes on and talks about, how we have this theory, we're trying to build this theory, but if it just connects to itself and it doesn't connect to anything in the real world, then we're not really getting anywhere. We have to be able to connect the math, the theory to things on the ground. And I think the most interesting way to do that, again, is Merling's 4 prices of money, because each one of those prices is a market in the real world, and they're very observable. You can definitely observe the price. Many of the markets give you quantities, and there's a lot of facts involved there. And one of the things that you have to take note of is that I think economics in general, it has it's very relatively lacking in terms of the resolution in time. And so in economics, in a lot of things, they talk about the short run supply and demand and the long run supply and demand. So you're dividing all of time basically into two time points, one which is current, one which is future, and again, theoretical. I think Keynes like to say, in the long run, we're all dead. I think another way of saying it is that there's a saying that tomorrow never comes. Tomorrow never comes. So if you're going to do something tomorrow, it's never going to happen. The long run also never arrives. The long run never happens. We're always, there's a theoretical equilibrium that the economy comes to in the long run, and we never reach there. We're always in the present short run, changing situations, changing dynamics. So I'm losing my thread a little bit here. So the interesting part is the four prices, and the part about supply that you have to realize is that it has a time characteristic. So the supply chart, if you look at, for instance, market prices, financial market prices like stock prices or bond prices, the supply and demand is occurring over time. So, if you go back to Keynes's original thing, he was thinking about a open air market and what happens in the span of one day. So in one day, people demand a certain amount, and one day the producer has a certain amount that he needs to sell. There's a time aspect to it. And if you look at financial markets, it's also the same thing. You have the only supply and demand that actually interacts is the current at this moment in time. And then you can also look at what happens over a minute, an hour, or a day. And those are all relative to each other.
Yeah.
So one of the markets that someone else brought up was debt versus money, and debt versus money is interesting because it is bringing, again, the debt versus money market is just relating the future to the present. And someone brought up that the point that debt and money actually look very, very similar. And I think it's very interesting to look carefully at that market. And including all the facts that we know about the past of this market. And so if if we're talking about money, and you talk about in the past, you had the gold standard. So in the past, the US dollar was pegged to the gold standard. The US dollar, in the past, prior to 1930, was basically an IOU for gold. It could be turned in. Anybody could bring their money to change it for gold, or they could bring their gold and have it changed into money. Those two were pegged against each other. And what you end up is very similar to a bank's fractional reserve that you have. Like Marlene talks about, you have the base of the gold. So there's a certain there's a certain amount of gold, and that's the base money, and then all of the dollars are basically IOUs for gold, and you can actually end up with twice as much dollars as the amount of gold which they are IOUs for. So you have that amount of gold, but you have 2 times or 3 times or 5 times the amount of money which is IOUs for the gold. But that works fine, just the same way that a bank works fine, because people don't all go to exchange their golds all at the same time. So what you have is that you're connecting future gold and equating it to US dollars money, related to present gold, and they actually work at a 1-to-1 rate under the gold standard.
Yeah. So yeah, I mean, I think it's not just future gold and present gold. So the dollar bills that are circulating, they are IOUs for gold, but they're not IOUs for gold in the future. They're IOUs for gold on demand. They are convertible to gold right now. So I think it's less of a future thing. It's more of a present thing. So the dollar is,
it's still in the future, because if everybody turned in the certificates at the same time, you wouldn't have the gold to pay for it. So it only works because
sure. I mean,
it's not like a set in terms of it's exactly 1 year, but it's a variable. Anytime in the future, you can exchange this for gold.
It works based on the idea that not everyone is going to redeem their certificates for gold at the same time. Nevertheless, the fact that it has the potential to be redeemed for gold right now in the present is what gives it its value. So it's interesting, when you talk about under the gold standard, the dollar used to be pegged to gold. Well, at the same time, it was also pegged to consumer goods. The dollar still had to be stable with respect to consumer goods. So under the gold standard, we're really pegging to 2 different things at the same time. We're pegging to gold and we're pegging to consumer goods. We didn't have, well, depending on how far back you want to go, we either had the Fed or we didn't. But
I would argue that actually it was pegged to gold, and the price of goods were actually allowed to deflate against the price of gold.
To some extent, I mean, we weren't perfect at it, but remember that the function of currency, of the economy's money, is to have stable purchasing power. So it has to have some exogenous stability that's coming in from outside the market. Now, maybe we weren't that good at enforcing that exogenous stability when we were on the gold standard, because we're kind of like, oh, well, gold is stable enough, that kind of thing. But it certainly did have an effect. The fact that we were creating all of this paper gold that was IOUs for gold, and people were spending using these instruments, that has an effect on the flow of spending, and it has an effect on the price level and all of that. Maybe we weren't calibrating it and pegging it perfectly to consumer goods the way we are closer to doing now. But it's just kind of like there's this inherent tension in a gold standard that I'm kind of trying to draw attention to, which is that your currency, in order to be optimal, it needs to be stable with respect to consumer goods. But if you're on a gold standard, then you're forcing yourself to keep it stable with respect to one particular commodity, gold. So that creates a tension. And the extent to which we were trying to toe that line or not is, maybe up for debate. Yeah.
Right.
So
to go back
go
to what Derek was talking about, to make this equation actually interesting, the equation that would be interesting is to look at the supply and demand of the four prices of gold, four prices of money. So, what happens on the foreign exchange markets? Your supply versus demand, versus other currencies. What happens on the present future market, the interest rate market? Present versus future money.
So I think you're leaning too heavily on the four prices of money here. So obviously they're all important in kind of the market for money, and how the whole system works and stays functioning and all of that. But there's really one price that matters here when you're talking about the quantity theory of money, and that's the price level. And certainly all of these other things can affect the price level. If there's a breakdown in the payment system, if there's a breakdown in par, if something happens to exchange rates or interest rates, all of those things affect the price level. But there's really this, there's this central price when you're talking about inflation, and then other things are secondary.
Right.
Does that make sense?
So the price of goods is kind of definitely the thing that we're most interested in targeting. So we're interested in keeping the price of goods stable. So we want that supply demand, market to be stable. But the things that are really interesting that will affect the stability of that market are the other, I'll say the other two, because par is not very important right now. So the other two, particularly asset markets. So with quantitative easing, with the Federal Reserve, printing money into the debt markets and lowering the interest rates, what you're doing is actually.
So
and
I
this
think
goes
you're right.
back
I'm going to interrupt you and kind of get to other people. These other markets are important, and they do affect the price level very strongly. But then we can ask the question, why are these other markets for money so important? And if you have a basic income and you're funding consumers directly, then maybe you don't need to use interest rates to prop up consumer spending. Maybe you don't need to, maybe these prices become these other prices of money become, kind of endogenous variables, and you're getting consumer spending to the level it needs to be. And then as a result, the Fed is setting interest rates where they need to be, and the exchange rate kind of goes to where it needs to be based on the market and that kind of thing. So you're kind of coming at it from a different direction when you have a basic income.
So my point very briefly is that the interesting thing to understand here is that because on the goods market, the consumer supplier of money does not have enough money. As a result, the Federal Reserve is pumping money into the asset market to try to get the money to the consumer. Right. So what you end up is having an enormous amount of money that has been exchanged for promises of future money. So you have an enormous amount, with the government, racking up, accumulating large amounts of deficits. You have this, 20 something trillion dollars worth of bonds where future money is promised for current money at a very, very cheap price, at a very low interest rate.
So again, I think you're overemphasizing the future money versus present money. The assets have a market price right now in the present,
right?
And the dealer markets for these securities, they are not concerned about the the future payment when the debt reaches maturity or something like that. They're concerned about what the price is right now, and they're buying and selling on a spread based on what the prices are right now. So these assets have value right now. So when the Fed wants to backstop any of these markets, it's about propping up prices right now. It's not about like ensuring that the bonds will be paid when they reach maturity or something like that.
Right. So the reason you have to worry about the bonds is because if the bond market begins to feel that the future value of money is going to go down, all of that supply, all of that stock of funds and bonds will come out of the bond market. They'll also want to exit the dollar. They'll go into gold. And what that does is create an enormous amount of supply of money on the asset market, which would push the value of money down, including on the foreign exchange market, which would also push the value of money down on the goods market, because much of our manufacturing is done outside of the country. And so if the foreign exchange market goes down, then the prices of our goods are also going to go up. So that's kind of the path towards inflation and maybe even hyperinflation. That's my point. That's the danger of pushing all the money into the wrong market, the asset market, when really it should be going into the consumer market.
Yeah. So you're worried that the asset market will reach a tipping point where it'll tip over into everyone converting their assets to cash, and that'll cause inflation, that kind of thing.
Yeah, absolutely. It's a bubble in future money.
I mean, I'm a little bit skeptical of that, because when everyone starts selling their assets, you get a few people who get out, and then other people are left holding the bag, unless the Fed decides that they want to continue holding the bag, and then that would be inflationary. I think that's a reasonable point. It depends on what our monetary policy is going to do and that kind of stuff.
Nobody wants to be holding the bag, so everybody tries to get out at the same time.
The Fed might want to be holding the bag, and again, this is what QE is about. It's like they're holding the bag because no one else wants to, and they're doing it not for their own profit, but yeah, exactly.
Right, but the Fed can hold the bond bag, but they can't hold the money bag, because they're just all they can do is exchange money for bonds. So instead of so the bond bubble goes into the money market because the Fed is printing.
So the Fed has to decide which bag they want to hold, right? So if the Fed holds the bond bag, they're not holding the money bag. If the Fed, the way the Fed holds the money bag is by allowing the bond prices to crash, by not backstopping those markets. So then the interest rates on those bonds go way up, the prices go way down, and people can't have access to the money. So that's the way they hold the money bag.
They can't do that because that crashes the economy, which is the whole part of.
Depends what you mean by crashes the economy. Crashing the bond market is not necessarily crashing the economy, especially if you have basic income. But I mean, so there's a lot of hypotheticals here, and I think a lot of them are very interesting, and we could have more discussion about it. But I do want to move on from this particular point, because the quantity theory of money itself, it's influenced by all these things, or the quantity of money, or the level of consumer spending, it's influenced by all these things, and these things can get really interesting and really complicated. But I want to kind of come back to a higher level way of thinking about it.
That's
gonna.
The interest rates, when the interest rates go up, that's going to drag on the economy, which will be very difficult to accept. Probably will not really be acceptable. But that's fine. We can continue on Discord on another day.
Yeah, definitely. So let's. I want to go to actually another screen share, which is not from the article, because it's my own thing. So this is the income theory of money. So it looks a lot like MV equals PT, but we've replaced MV with R, which is just the flow of consumer spending. So hypothetically, you could break it down into M and V, but I don't think there's a practical. I don't think that's useful. I don't think it gives us any insight to break consumer spending down into, oh, well, how much money is there and how fast is it being spent? Instead, we can just look at the flow of consumer spending and understand what that level is. And then on the PQ side, I changed the T to Q because I really wanted to emphasize the level of output. I could have made it a Y or something like that, but the quantity of output that the economy is producing for consumers. So you have the level of consumer spending equals the quantity of output. So these are the two flows, and then the P, the price level, is just the ratio between them. So in order to prevent inflation, you want to make sure that R and Q move together, and there are a lot of things that can kind of affect that. So maybe a basic income increases R, but because it's kind of what Bethany was getting at earlier, because it's distributing income to consumers more evenly, it makes it more profitable for producers to produce higher quantities because you've made demand more elastic. So that allows you to increase R at the same time that you're increasing Q, and the price level could stay the same. Here you're imagining a scenario where the economy could be producing more, but it's not, because it's profitable to produce less than the full potential output. So basic income can bring us there. It could also potentially, maybe Q doesn't increase, maybe Q and R stay the same, but the distribution of spending changes. So maybe rich people are buying less and poor people are buying more, and that's more of kind of a redistribution type scenario where the economy is already at its limit, and you can use basic income to redistribute. You're not necessarily taxing the rich and giving it to the poor, but you're redistributing. You're changing the distribution of consumer spending to get the economy to its full output. So that's kind of the final thing I want to leave us with is this equation, and then the other equations you can imagine are still valid. If there's a certain level of consumer spending, then in the Cambridge approach, you're going to have people are going to be holding a certain amount of money as a consequence, a certain amount of cash as a consequence of the economy just doing what it does. And then the Fisher equation, the equation of exchange, it just is this equation, except you're kind of breaking R into M and V, and you're declaring that this stuff is money, and then any other spending is just a multiplication of that money or something like that, that money spinning faster and faster. And the reason why, part of the reason why I really like this way of thinking about it is that in the quantity theory of money, it's not implied by either of the equations, but there's this kind of assumption that there's this fixed amount of currency that's out there circulating, and these are like coins, and they're self-same coins, that it's the same coin that keeps going around, or the same number of coins that keep going around at a certain velocity. And that doesn't necessarily have to be true. It's not directly implied by the equations. It could be that coins are being created and given to consumers, and then they're flowing through the economy and they're getting smashed up at the other end or something like that. But I think that's a more accurate analogy to how our money actually works. It has a source and it has a destination. It doesn't just keep flowing in a circuit in the economy. Or it doesn't have to be. There are some backflows and stuff like that, but you have to answer the question of what's the mechanism that's getting spending money into the hands of consumers. You can talk about money, when people save, it's reinvested in the economy, that kind of stuff. You're still not answering the question of, okay, but how does it get back to consumers? Or how does money get to consumers at all? And basic income is an answer to that question. It's the source of the flow of consumer spending in the economy. So money flows from consumers to producers, and goods and services flow in the opposite direction. That's a little slice of the economy. That's the productive economy. Then other things are happening outside, lots of complicated stuff, but that's the most important part. That's the part we need to get right, and everything else kind of serves that. So that's more the income theory of money. So inflation is determined by the flow of consumer spending and the flow of economic output matching up with each other at any given time. So we are getting to the end. I know Derek and Martin have had their hands raised forever, but we're actually going to start with Derek on the closing thoughts. So go ahead, Derek.
So we'll have to wrap it up quickly. I like the income theory of money. If you're interested in that, you Google origin of income theory of money PDF. And what I like about it is not just the simplicity of the mathematical formula, but the story that goes along with it. It's very plausibly true to me that this holds true for an individual business, for a group of businesses, for the entire economy, in a way that I don't think QTM does. And it's useful, I find, because most of the time when I'm talking about basic income and I'm trying to, convince people it's a useful or interesting idea, the objections may not be explicitly QTM, right? And so if you can identify to people, hey, you're talking about, this is called quantity theory of money. This is this assumption that the total quantity creates inflation. You can then formally pivot to ITM, income theory of money, and says this is a different theory. And then we can start weighing the two theories. So I found income theory of money really helpful for that, as just having another plausible story to tell about the causes of inflation, where it comes from.
Okay, great. Let's go to Steve.
Thank you. I have the following Zen-like closing comment that money or water or anything that flows through fast places and slow places will all end up in the slow places. That is all.
I like that. That's good. Let's go to Martin and then Bethany and then Ian.
So it's a comment that I was more kind of an observation that let me go to another field, IR, international relations. And so often I'll listen to PhD, and the PhD will give the theory. They're just written a paper, and the theory explains why such and such happened in this particular international relations event. And then the person will say, okay, so now let's go back to Richard Nixon, and I'll show how what Richard Nixon did is explained by my theory. And my thought is, you weren't even born when Richard Nixon did that. So the one thing we know for certain is that Richard Nixon did not have access to your theory. So, and I offer that as up as just a little bit of sort of like chicken and the egg, which is a theory to explain something. But if it's explaining something that a process or that someone is doing, and that person does what that person is doing without ever having learned the theory, then it's just an observation. But this comes up a little bit, and to tie it all back to in this particular topic, to tie it back to basic income, most of you are perhaps thinking of basic income as something on the nearer horizon than I am. But I would suggest to you that economic theory is going to be your greatest enemy. Because what's going to happen is somebody's going to have an economic theory that explains why you can't do what you want to do. And you, on the other hand, may find yourself, no, I have this other theory, and it explains why this is a good choice or it is a good course of action. To which I would simply say, get everybody out of the mindset that you've got to have a theory that explains this. There's an awful lot in life that we do iteratively. And, for folks who worked in technology and know agile development and lean production and all this kinds of stuff, you have this mindset where you don't just completely block everything out until you've got enough people on your side because they adopt your theory.
Yeah, I appreciate the warning. I don't know if I'm going to heed that advice or not, but I like it. Let's go to Bethany and then Ian and then Mitchell.
Yeah, it was just a great discussion. I don't have too much to add, but thanks so much. It's really interesting.
Okay, Ian and then Mitchell and then Richard.
Yeah, thanks, Alex, for facilitating this. And I apologize for misquoting you, and I appreciate Bethany for clarifying that. And I wish I was more economically minded, because it seems like you and Eddie hit a snag there, and it seems like you both know a lot. So it's interesting to see that back and forth. But yeah, great discussion.
Yeah, we like to put on a good show. Let's go to Mitchell, Richard, and then Dan.
I'll pass on final thoughts.
Okay, Richard, Dan, and then Joan.
I guess I'll pass as well. I'm not really good at economics.
Okay, Dan, Joan, and then Matt.
Yeah, I don't have any specific closing comments, but yeah, another good discussion. Thanks.
Okay, and it looks like we lost Joan, so let's go to Matt. And then Eddie.
All right. Yeah, thanks everyone. This is great. I definitely got a lot to think about. Yeah, I mean, I'm still learning a lot of this stuff. So I'm not entirely sure my thoughts on it. It seems like there's some truth to it, the quantity theory of money, but it doesn't make any, or people talk about it as if it makes a claim to the causal aspect of it, but I'm not sure that's the case. I sent 2 links in the discussion for this Zoom call, one of which talks about the oil crisis of the 70s. And the author claims that the money supply increased after the effects of inflation because more money was needed to, have the economy work roughly the same way. So it seems to me that, I guess inflation is more tied to demand rather than the money supply. And demand and the money supply are often going to be linked, but that doesn't really tell the whole story. So I think to make it really work, you need to talk about like propensity to consume, and also, your degree of like income inequality and like wealth versus like liquid spending power. So I guess there's just a lot more to it than just saying, oh, the money goes up and then prices rise. So I guess that's just something that a lot of people believe, and that as basic income advocates, we probably have to have evidence to dissuade people from, because that, in my experience, stands in the way of people getting on board with this idea a decent bit. So.
Yeah, and I actually don't see the links in the chat. Did you send them to everyone?
Oh, I sent in the Facebook group.
Sorry. Oh, in the Facebook group. Oh, perfect. Great. So then everyone will be able to see it later. Let's go to Eddie. Final thoughts.
So I agree with Alex that theory is very important in terms of telling us what we should do, why we should do it, and what to expect about it. To give a nutshell summary of the economy, from the 70s to now, the tendency for the consumer for the goods price is to go downwards because the consumer is slowly being deflated. So consumption is not enough. You have the Fed inject money into the asset market to push up the asset market and to push the productive capacity of the economy towards building capital goods. So if people can't consume enough to keep the economy busy, the Fed pushes the economy to put that capacity instead into building up capital goods. But eventually the capital goods, you have too many capital goods, you still don't have enough consumption. And so as a result, your interest rates are at zero. And we're at basically the end of that working, and we need the money to actually go to the consumption, back to the consumer, to create sufficient, to put the money back where it should be, the correct market out of the current markets, because it's in the wrong market right now. Yeah.
Okay, good final thought. So my final thought is going to be, at one point, Matt mentioned that maybe GDP is the limit to government spending. I would probably say, instead of that, I would say that potential economic output, not GDP, including what you can buy as imports, that kind of thing, potential economic output is the limit to consumer spending. And then we can use government spending to fund the consumer spending. And that's what basic income is. And as far as quantity theory of money goes, you might have noticed that in both of the equations, they were talking about the money stock. They were talking about the money demand as a stock, and they were talking about the money supply as a stock. Everywhere else in economics, supply and demand are flows. How much something in a period of time. So with the income theory of money, we're talking about how much spending in a period of time, how much production in a period of time. So it matches up better with the rest of economics. So this is a great discussion tonight, you guys. Next week, we are talking about global basic income. So what about basic income at the level of everybody, all countries, the entire world? Is that something that's desirable? Is it something that's feasible? What are the implications and complexities of it? How do you make it happen? So that's it. Thanks, guys.
Bye, Alex. Great discussion.
Thanks, Alex.